It's been almost 2 decades since we started our journey to educate and help you take action so you may better manage your financial future. Our goal is to help you accomplish your life's purpose. This podcast reveals financial tips, strategies, and insights that will help you to set your financial goals and guide you along the way. This is Managing Your Financial Future, brought to you by the advisors at Lucia Capital Group. All right, welcome back, Managing Your Financial Future. Thank you so much. I always thank myself for that wonderful intro that I heard.
As long as you get the name right, you're doing fine.
That's true. That's true. It is Managing Your Financial Future. Oh, one of these days I'm going to say the name of our old show.
Well, you said that for so many years, it became habit.
But neither one of us is going to catch it, and I'm going to say, welcome to the, whatever it was, the Boomers Brain Trust show, or the...
what were all the names?
Anyway, I don't want to get myself confused. I am Johnny Dean. I'm your podcast host, and I think I do a pretty good job of this, keeping Professor Plum steadily...
On target?
Yeah, exactly, because there's so many different ways we could go. Professor Rick Plum here with me, Certified Financial Planner, CFP Professional, if I've said that correctly, and I thank you once again for joining us. We do want to get into some tax stuff today. Depending on when you're listening to this, unless you're listening to this, 5-6 months from now, I would say that those who are listening to us before tax time 2023, you're going to want to get this information because it's important, and it may save you some headaches down the line.
Well, it's always one of the hardest parts about doing your taxes is finding all the forms and getting them together to get started,
isn't it?
Yeah, it's where would that receipt from Goodwill go? Where did I put that? Where did the I saw that 1099. Where did I put that for safekeeping?
Yeah,
it's in a very safe place. I just can't remember where it is.
It's so safe that I don't know where it is.
But putting it all together and just when to expect things, what to look for, and making sure that you get things straightened out ahead of time.
Oh yeah,
so that makes actually doing the accounting on the form much easier.
It is, and whether you hire an accountant or somebody to do it, or you do it yourself through TurboTax or one of the other programs, you are going to need it. And there have been a few times where I've been in the middle of doing my taxes, and it's asking for something that I did not have, and it would be, knowing that I owed money at that time, I hadn't done it till like April 10th, and I thought, well, I better find this or get a copy of it sometime like in the next...
Pretty quick.
Yeah, in the next day or two. So it's important to be prepared and ready. So, prepared and ready, same thing. It's important to be ready for whatever you're going to be asked to give. Part of the problem, now see, when you do your taxes yourself through one of the tax preparation, software, whatever it is. I know TurboTax is a big one, but that's one thing. If you hire an accountant or somebody to do this, they can only operate on what you give them, right?
Right. The information that you give them.
Right. So I want to get into also a little bit about what are the things that you need to tell your tax preparer about, because they may make certain assumptions if you don't give them all the information. And we've seen situations where people wound up paying more taxes or owing more taxes than they actually did were supposed to pay.
Usually not the fault of the accountant. Every once in a while, the accountant misses something, but it's a matter of communication. You gave them the forms, and one of the problems are we get these forms 1099s, and there's multiple different 1099 INT, 1099T, 1098, 1099B, 1090 DIV. There's who knows what these things all mean. So we just take them and we give them to the accountant. We don't know what it means. So how are we going to tell the accountant, oh, by the way, unrelated to any of this, or maybe related to this, I don't know. I did this kind of thing through the year. Oh, but I forgot about doing that. We did that in January last year, and I forgot all about doing it, so I didn't tell the accountant. All the accountant is working with, all the tax preparer is working with, are those forms.
Yeah.
And those forms may only tell part of the story.
Right.
And so understanding what you have done and communicating that with yourself, now the tax preparation software is for people that do them themselves. Try to ask these leading questions that help remind, yeah, I did do that.
Yes,
yeah.
Which is, I tell you, it's wonderful. They've gotten much, much better over the last 30 years.
And if if you've forgotten that you rolled that money, forgotten that you did a QCD, forgotten that you did all these things, they're trying to, without making you, being condescending, refresh your memory. But if you don't remember, if you're not doing your taxes and you hand all your paperwork to an accountant, the accountant usually is not doing the tax return with you sitting next to them.
No.
They're doing it and then handing it back to you and saying, sign here, you owe, or you're going to get a refund of X. But you got to communicate with that person everything that you did tax-wise last year that may affect the return, but you may not even know what you did.
Well, let's talk for just a moment about the things that you need to have in order. You mentioned, knowing where your forms are. What are some of the things that people need to have, and how do they organize it?
Well, organizing it is, first off, having it all in the same place. So what I would recommend is getting an envelope, one of those big manila envelopes with a nice little clasp on it. And
the clasp that always breaks. I mean, like after the third time you open it, the little metal thing breaks.
Try to be a little more gentle. I've never had an issue with that.
You've never had that? I mean,
not that I can remember.
After 3 or 4 opening, I like the kind like the memo kind where there's a little piece of string. And
that's the old style.
Yeah, because that won't break. Anyway, I digress. You digress.
Get something that you can put.
There you go.
So when you start receiving all these different 1099s, I received a 1099 INT the other day, but I didn't know it was a 1099 INT because it was from the Treasury. It was the dreaded letter from the IRS.
Oh, man.
And I've said this before. I don't care if you know your tax return was pristine. When you get a letter from the IRS, from the U.S. Treasury, you're thinking, oh my gosh, what did I do wrong? How much am I going to owe? This is not going to be good. 3
words go through my head. Homina, homina, homina. And I kind of repeat that over and over.
And I already, last year I had to go through a mess with the IRS. They had fouled up my return, and I had to get on the phone with them for a couple of hours and straighten the IRS out. So we got that taken care of. I'm thinking, well, did they go back and look at other returns and try to find something else? What I got was, I opened it up, and it was a 1099 INT, and it's basically telling me the amount of interest that I earned from their little snafu, because they owed me a bunch of money, even though it was only for several months. They owed me some money. They paid me interest. And so that interest they paid me, I have to put on my tax return for last year because they paid me interest last year. So it wasn't a bad thing other than now I got to pay tax on something I forgot that I didn't even remember I got interest on it.
I'm sure it was a ton of interest.
It wasn't bad. I mean, it was more than a couple tanks of gas.
It's in the 3 figures.
Yeah, without the decimal.
The low 3 figures. Yeah, exactly. So things like this. What you're saying is things like this.
I get this 1099. I got my W-2 a week or two ago.
Yeah.
I got my I got a 1099 INT from my money market, a week and a half ago. I'm expecting, the 1098s, the from the mortgage company, you're expecting different forms coming in. My 1099B from stock sales and 1099D for dividends. If my wife has a pension, she's going to get a 1099R. So we're expecting all these different forms. And where do we put them? I mean, so what I do is I just put them into an envelope so that when I do sit down, everything is there, and all the different charitable receipts, from the different times we donated furniture or clothing or whatever at different times of the year. We've been putting those into an envelope, so they're all together. So everything's in the same spot, so that everything we can think of is ready to go when we sit down and do the taxes.
Now, generally, people who get stuff in the mail, and sometimes you get your W-2.
A lot of tax forms in the mail, but some are now online.
What I've seen is that it'll usually say important tax information enclosed.
Right.
Now, I know which, garbage mail to throw out and stuff that looks official, but I think if it says that, that's something you should at least open and check it.
Well,
maybe something you want to keep.
Yeah.
Right?
And get ready for it. But you should be expecting to start receiving all these different forms. And now if you're listening to this in March, April, May, you should have already received all these forms.
Well, many of them.
Exception maybe of the K1.
K1s can come later on, yeah. But so what you're saying is it's important to keep all this stuff as you're getting it. Anything that may have come, most of it arrives after January 1st, I would assume.
Well, after January 1st, definitely. But most of them arrive towards the end of January, into February. The last week or so of January, first couple of weeks of February.
Yeah. So if you
then 1099s from brokerage companies, they can be corrected, and so you may get a couple more of those between now and the end of the filing season. But and if you have partnerships, limited partnerships, if you have illiquid assets, if you have real estate investments within your brokerage accounts and things like, I'm not talking about you own a rental or something. That's another game. But if you have real estate investments through brokers and things, expect many of those to issue corrected 1099s. So unfortunately, if you have those types, master limited partnerships and things like that, expect you're not going to file until closer to April, because what happens is through the year with those types of investments, they may be paying a distribution. Maybe have $100,000 in this master limited partnership, and you're getting $500 a month, $6,000 a year, a 6% distribution. And so the brokerage company knows that you've been getting this $500. They're issuing the dividend, the thing saying, well, you received $6,000 in distributions. And they haven't received anything yet from that investment company telling them that, oh, by the way, only 30% of those distributions were taxable. The other 70% was coded as something else that isn't taxable. And so even though I got $6,000 in cash, only $1,800 of it's taxable. But the first 1099, they haven't gotten the information from the investment company. So they say, hey, $6,000 you received, it's all taxable.
Why don't they just wait? Why are they sending?
Because by law, they have to have the 1099 out by a certain date.
Well, some have to come in January, some are in February, some are in March.
And so what I'm saying is if you have these types of alternative investments in brokerage accounts, you may not want to be an early filer. If you have limited partnerships, you may not want to be an early filer. If you have anything that creates a K1, you may not want to be an early filer because you'll probably have to amend that return.
Well, I mean, even if you get it in by April 15th or whatever the actual date is,
sometimes K1s come, corrected K1s come even after that.
Right. So many people, they either file their taxes or they wait, they file for an extension and things like that.
Yeah, they file an extension and
then
with
wait
an expectation
to see what happens.
Right. So there are things that you should be looking at, but the first thing is to be prepared and be ready to go. Second thing is understand when you may want to file. Obviously, you mentioned it earlier, if you're going to owe money, you probably don't want to file until April 15th. I think we have a reprieve for a couple of days this year again.
I didn't look, but
I think the 15th is on a Saturday this year, which means that we have until Monday, but Monday's probably a federal holiday, so we probably have until... I know, it's probably Tuesday, but so you got a few days after April. But
people can look it up themselves. I can't reach my computer. And
so when you're ready to file, if you're going to owe money, you probably don't want to pay them the money until the last second. Now, those other people who get refunds want to file really early, but if you've got complicated tax situations, you may not want to do it, so you don't have to do an amended return.
Yeah, but you still have to be aware of what's going on,
right?
And you got it's going to be on your mind. And a lot of those people, I think, people with K1s and things like that,
they're getting used to it.
They've most likely done it for a little while, and maybe they've got just enough complications in their taxes to take to somebody who's professional enough that they've seen the stuff before.
Now, where people get tripped up are when they receive these distributions or when they receive these forms, 1099s. They need to know what's going on. There's a few areas that are not straightforward. If you did rollovers from an IRA to another IRA, and you've also taken distributions, maybe you're retired, you're taking distributions, but then you rolled over an IRA, it may not show that. They may just show the entire distribution.
Well, give us a made up but concrete example of what we're talking about here.
I was dealing with somebody a while back, and they had an annuity, a fixed annuity that was paying a reasonable rate of return for the time, and they were taking $2,000 a month out of the account. So they're taking a $2,000 a month IRA distribution. It's all inside their IRA. Through the end of the year, it was doing fine, but then they realized that the renewal rate on the annuity was just dropped to the floor. Back it was paying less than 1%, but you could get treasuries, last October paying 4%, 4 and almost 5% at some point. So they said, well, let's take this money out of the annuity and transfer it to a brokerage account where we can buy a treasury and get 8 times the interest that we were getting in the annuity because it was an old annuity that wasn't paying very well. But they've been taking distributions for 10 months. They took $2,000 a month out of it. They took $20,000 out. But then they rolled over $200,000, and the insurance company that was dealing with it, we've talked to the insurance company. They're going to just say that they took $220,000 as a distribution.
So that's all they know.
And so instead of coding the 1099 as part rollover and part distribution, they're just going to code the whole thing as distribution. Now that's not a big deal if you know how to handle it on the tax return, which is very easy to do if you know and you've communicated to the person doing your taxes that that's what happened. If all you do is turn over that $220,000 1099 to the tax preparer,
they're just going to say, well, that's income, right?
That
there.
It shows as income. They're going to put it into the computer. The computer's going to put it on the right line, and you're going to, hopefully the tax preparer is like, so what did you do with that $200,000?
Well, maybe they will, maybe
maybe
won't.
they're busy.
They could, yeah.
So if you've told them that 20,000 of it were distributions, but 200,000 of it was a rollover, then they can put it on the tax reform the right way and only show 20,000 as taxable. Now that's a big differential. Now, what if it was only 5,000 remaining and it was only $25,000? So we took out the 20 and then 5,000 was rolled over.
You mean you took out the 20 as a distribution?
As a distribution, and then
you rolled five over.
So the 1099 says 25. The accountant probably wouldn't be, oh, that's normal, even though, and so you may end up paying tax on $5,000 that you didn't need to pay tax on.
And that's not something that you would ever catch unless
it's hard to catch unless you've got that good communication and you know what's going on.
So would you advise anyone who's done a rollover, who did a rollover last year, to notify?
Oh, to tell their accountant. Oh, by the way, you're going to get a 1099. Some of this was rolled over. Here's what happened. Just tell them what happened.
And I haven't done any rollovers, at least not since I've been using the tax software. So I don't know whether even the tax software.
Software usually asks.
It will say, "Did you have any rollovers?"
What did you do with this money? Did you keep it? Did you do? I think it says something in the fact of, did you roll it over? Yes or no? Or did you do something else? It's like, yeah, I did something else. I paid for groceries with it or whatever. But no, I rolled it, or I rolled it over, or a little bit of both. So
okay, so that's
But
probably
and it's not every IRA custodian that will treat it that way. Some IRA custodians will do, if they know it's a transfer to another IRA, will do two 1099s, one for the distribution and one for the rollover. Then people are up in arms about, why did I get two 1099s?
Yeah,
but unfortunately, so that's one area that trips up people. Another area are for people that are retired 70 and a half or older who did qualified charitable distributions.
QCDs, as they're known.
If I take X amount of dollars, $10,000, that's a big gift. 5,000, 3,000, whatever the number is, I take it and I do a qualified charitable distribution with it. Send it directly to the charity.
Yeah, let's just clarify for those who have not heard us talk about those before.
So let's go back. I have an IRA and I'm taking $2,000 a month from it to live on, but I also want to make a charitable donation to my alma mater, my church, the zoo,
whatever.
Pick your bona fide charity. And so I do what's known as a qualified charitable distribution. And I want to give them $3,000, making numbers up here. And I have the money sent directly from my IRA to the charity.
In other words, you don't take possession of the money. You don't say, send me the money and I'll write the charity a check.
Nope. The check is drafted at the IRA, from the IRA to the charity, not to me. Now, so I've taken $2,000 a month, $24,000, and this $3,000 charitable distribution. That's going to show up on my 1099 as $27,000 of distributions. There is no code on the 1099 for a QCD, a qualified charitable distribution. There's no way that we can tell the IRS by a 1099. There's no way that the IRA custodian can tell the IRS that, hey, we wrote part of this distribution to a charity. There is nothing in the works. There's no mechanism for that kind of tattletaling. The custodian, the only option they have is to say they took all the money out.
So even though the custodian had written a check to the charity or whatever they did, they, in essence, knew where this
They knew it wasn't
money
a distribution to you. They knew it wasn't taxable, but from the mechanism that's in place, they're just going to code it.
They just say, this amount of money
distribution
left the IRA.
And we've received calls from people that were very unhappy that we want a corrected 1099. We want the 1099 that shows maybe they didn't take any money from that IRA except for the QCD.
Mm-hmm.
And they said, we want to show the IRS that we don't have to pay tax on it. That's not how it happens. You show it as a distribution.
So the IRS
you account for it as a. So if you've ever looked at a tax form, there's some boxes in the middle of the page and there's some boxes on the right-hand column. The boxes in the middle of the page say how much was distributed from your IRA, one of the lines, line 4.
So that's the number. You put the number there.
And then on the other one is how much of that distribution was taxable. And so so in my example, I took 27,000 out, but 24,000 to live, 3,000 as a QCD. So I put 27,000 that was distributed from my IRA.
Right.
And on the taxable column on the right side, I put 24.
And when it says how much of this is taxable,
Yeah,
so they actually ask you on the tax form.
Yeah, it says taxable portion, but it doesn't say how much of this is. But
they should make it clearer, you know.
A little condescending.
Please. So you would put, in that instance, you would put, if it says taxable amount, you would put, in your made-up example, you would say 24,000.
In this case, yes.
And then, so how do they know that, how do they say, well, there's a $3,000 discrepancy here?
Right, there's
Mr.
a little
Plum.
line, in most of the time people will put in the initials QCD. Or
so you would write on it.
You would write on
QCD.
it, or the computer writes on for you.
Whatever.
If you've done a rollover, it could say rollover there.
This is important. I mean, honestly, and it's probably more important for people, as you said, who maybe didn't take any distributions from their IRA because they're not.
Maybe they're 70 and a half, but they're not
72
yet. Last year,
or they took them all from another IRA,
from a different IRA,
right?
Yeah.
So and said, well, I'm not taking any RMDs from this IRA. I'm going to send $3,000 to my church, which
right.
I do every year in lieu of putting the money in the basket every week or whatever. So I'm going to send $3,000 to them, and that's the only money that left this IRA.
Right.
And then they get upset because they say, well, what in the world? I
want the 1099 that shows I did a QCD.
But there isn't one.
There isn't one.
Yeah.
And so there are a lot of little things like this that you need to communicate either with the computer or where you're doing your taxes. Luckily, like we said before, the computer is much better nowadays of asking you, hey, what did you do with this money? We're trying to find a way to help you out here. But if you're, just hand this to your accountant, your tax preparer, and you don't tell them you did a QCD, they don't know you did a QCD.
Yeah, we're back in that same boat that we talked about with rollovers.
Right.
I mean, I think people are...
and especially since the distributions, you're taking distributions to live, and you take... Usually the QCD is not the biggest part of your distribution, so it's not something that looks out of line in many cases, and so the accountant may not even question it. They may say, "Well, that's about what they're spending." Yeah, sounds right.
Yeah, I don't know that accountants necessarily, especially if they're busy, they may just people do tend to, and I would be this way if I still had my accountant. I was this way. I had a box full, or maybe it was an envelope full, of all my stuff that I got, and I didn't look at it and pay much attention to it. I would just hand it to her, and I'd say, here's my stuff. Call me when you're done.
Do it,
and
tell me the
done.
bad news.
Yeah. Oh man, I'll tell you. But my account at that time, and it's been many years since I've used her, but she wouldn't know if I had done a QCD or rollover or any of that stuff.
Another area I've seen people have this communication failures. And we didn't see it for many years because it just wasn't a very fun option. But now with interest rates back where they were, they've redone some rules in the 72T payout area.
72T. That's the way to get money out of your tax-deferred account.
Before you're 59 and a half.
Yeah. It can be well before.
Substantially equal payment plan. Systematic payouts.
Yeah.
And where we've seen this come back to bite some people, it's not the 72T that's the problem. It's, again, the accounting and the communication. You've got 4 or 5 IRAs at different places, and you start taking a 72T payout based on the entire IRA balance. Mm-hmm. But you're taking the entire distribution from one IRA.
Yeah.
Well, the custodian may or may not know that it's a 72T, or you may have told them, but they say, well, these numbers don't work. You've got $200,000 here, and you're taking $20,000, $30,000 a year. That's not 72 much.
Yeah.
So they issue the 1099 saying that it is a premature and it should be penalized distribution. But in the grand scheme of things, it's not, because you're taking the distribution based on your entire IRA. And so you have to, if you don't know any better, the computer or your tax preparer is going to automatically kick out the form and say, this has got a 10% penalty with it. So you'd end up paying, in that example, you'd end up paying $2,000 in penalty tax on top of your regular ordinary income tax. Whereas if you tell the accountant, hey, this is part of the 72T. So here's all the calculations. Here's what's going on. You can file a form. If you know what's going on, that says this on your tax return, because the IRA custodian is not going to change it. You do it on the tax return.
You explain it on your tax return.
It's Form 5329 and say this is exempt from the 10% penalty. And in that example, it saves you $2,000 in penalty tax.
Well, I tell you, that's really going into the...
and unfortunately, I've seen this happen where...
the weeds there.
You set it up in January for somebody, and you tell them, remember, you're going to need to tell your accountant about this. You're going to need to tell your tax preparer. Well, by the time the next April comes around, they've forgotten all about it.
It's well over a year.
And then this has actually happened to me. I was reviewing somebody's tax return a couple years later. They were saying they thought they had a problem a couple years later. And I went back a couple years and I found, why are you paying penalties on this? It was only the first year that was a problem, but the first year, why are you paying a penalty?
Yeah.
It's like, I go, you didn't tell the accountant? No, I didn't tell the accountant. I was like, well,
I mean, you get into, I'll tell you what.
Luckily, they were within the period of time where they could go back and amend that return and file and get the penalty back.
Well, they had you on their side.
Yeah.
I mean, and as an advocate.
And I had told them to tell the accountant.
But even if they don't, I mean, you can't expect people to really necessarily always think about this. We're telling them now on this podcast because we need people to start thinking about this kind of thing.
What did you do last year that may require communication with the person doing your taxes? And
when you do think about anything. You said, just to rehash, rollovers, qualified charitable distributions, 72T if people are doing 72Ts.
Yeah, there's other things, but yes, anything that's somewhat out of the norm, and just be ready to explain what you did. Just tell them so that you don't have to try to amend your return at a later date, which can cost money, especially if you have somebody doing it for you.
Well, it can, because I think sometimes you may not even know it, and you won't know about this until maybe the IRS asks you some questions. Or
if they don't ask questions. When you voluntarily pay a penalty, they rarely catch that and send it back to you.
Or as you said, if you paid too much and you had no idea you paid too much in taxes, because who knew, Yeah. I mean, you had $5,000-$6,000 of extra income added to your tax return that really wasn't taxable to you because it was a charity, but nobody knew about this QCD that you did. And maybe you're just signing your return and not thinking about it.
So the keys are be prepared, get everything in one place, get them sorted out, and make sure you have everything. And then think about, did you do some of these other areas, rollovers, partial rollovers, do this, do that, and make sure you communicate that with your tax preparer, and it'll make your tax filing season much easier.
When you meet with a lot of clients and things like that, when you talk to people like this, do you recommend that they meet with their, would you have somebody, do you call people ahead of time and say, look, we're coming up on taxes here, you've done some things, let's make sure that we're communicating everything properly to whoever your CPA is? Because you don't, I mean, the Lucia Capital Group, they don't do people's taxes.
No, we do not.
So those go to an accountant, or the clients themselves do the taxes themselves.
We try to remind people if they've done QCDs. QCDs are the big ones that get overlooked and miscommunicated. So we do try to remind people through the review. We're reviewing a couple times a year in many cases with people. Make sure you tell. And now we're telling people, okay, let's get your taxes in order. Let's make sure you're doing this. Make sure we're doing it right.
Well, as you said,
because money matters, and we don't like paying the taxes that we actually owe.
No, and
let alone more.
As you said, they're not going to come back to you and say, you really overpaid.
There are times where they can catch something like that if you made a blatant error. But these aren't errors. Well, this is nothing the IRS can catch.
No, an error they will catch. I mean, if you put
if you did the math wrong,
if you put a W-2 that's if your W-2 said you made $60,000, but you actually accidentally put $160,000,
or you're entering the information and you said that you withheld your W-2 says you withheld $10,000 for federal taxes, and you just put it in at $1,000. They're going to catch that, and
that'll be an automatic catch, I would think.
Yeah, that one's an automatic. But the ones we were just talking about, and the reason we were talking about them is because they're not automatic.
Well, nobody knows.
Nobody knows.
The IRS receives a 1099 from your IRA custodian that says X amount left the IRA, and they look at your tax return and they say,
matches up.
They accounted for it. There you go.
That matches up.
All is well.
And I don't know whether or not Congress did that on purpose or it was just an oversight to mess with people. The purpose to mess with people or an oversight.
What, to make the
QCD, make it look like it's going to be tax free when they actually
half the time I think it depends on my mood. Half the time I think they do things on purpose,
right?
And the other half,
we're giving them credit for being smart.
But then the other half, I think there's no way these people
too stupid to do that.
They don't understand what goes on the tax return.
They don't.
You think they understand? They don't even understand how their own monetary system works. Do you think they understand how things work on a tax return?
We have a very cynical view of Congress.
Well, look at their track record. My goodness, I mean. And this isn't a political thing. This is just,
this is both sides.
This is the way. Well,
Both
I'm not
sides.
even talking about parties. I'm just saying this is just stating it the way it is. I mean, ask anybody in Congress. Do you know how tax law works? No, would be the answer I would guess for most of them.
But tax season is one of those seasons that most people do not look forward to. And I'm not saying you should look forward to it, but try to make it as easy on yourself as possible and be prepared for it. It's a necessary evil.
Well, what you said, there are things, like you said, there are things that you may have done a year ago, like a year ago January, and here it is the following April.
You may have sold some things back in January when the market was still pretty high, and you created capital gains, and you're getting this 1099-B that's saying you had a $20,000 capital gain. It's like,
I had
in a year like last year?
Are you nuts?
How did that happen?
Well, and those are surprises, but at least I think that would show up. There are things that you may have done that you completely forgot about.
Yes.
And then you have to let your accountant know. Your accountant gives you your tax return back, and you file it, and then you say 3 days later, oops, I just...
Then trying to get a hold of your accountant until 6-7 weeks after tax filing to amend it. Well, that's the problem.
Do they take time off like right after? By the way, our assistant told me the taxes are due on the 18th this year. There's the Monday's the holiday, so it's April 18th.
Okay.
All right. Well,
anyway, we got the weekend to do our taxes.
Try to do it a little bit ahead of time, I would think, if possible. I know. I mean, you may not want to pay it, but at least have them done. Yeah. And wait to send it until you're required to do so. Well, this is good information. This is very helpful information. People don't like to talk about taxes. People don't understand taxes. Maybe what we talk about here, either next time or whatever, is the confusing aspect. Since taxes seem to be on people's mind, is the confusing aspect of the tax bracket. When we talk about spending to the bracket, when we talk about using it to your advantage. I think people are really under some mistaken notions about what tax brackets are.
Right. Well, the terminology leading up to the tax brackets.
Yeah.
Somebody could take a look at the forms that are easy to find online. What are my tax brackets? What are the federal tax brackets? They say, okay, well, you can go up to 80,000-ish married filing jointly and stay in the 12% federal income tax bracket. But that's based on taxable income, not gross income. It's not even your real gross income. It's based on the adjusted gross income, which then get your deductions to come down to taxable income. And it's like, wait a minute, what are we talking about?
Yeah, so maybe this is a good thing. It's more on the lines of planning, but I do think that the more you know about tax brackets, because as I've said before, we've run into people, or at least I know you have, and we talked about them on the show, where they have said, don't pay me my bonus this year, wait till next year, because I'm right at the top of the 12% bracket, and if I get this $2,000 check,
it's going to cost me $3,000 in taxes,
right? Because now I'm going to be in the 20.
It's going to cost me more in taxes than my bonus,
right? I'm going to be in the 20-something percent.
That doesn't happen.
No, so it may be time for some education on that. Professor Plum, thank you so much once again for providing insight on this. If you're getting ready to do your taxes here. This year, it may be a good idea, especially if you got something a little bit more complicated than just some W-2s and maybe some interest,
or just your IRA and Social Security. That's what you have.
Yeah, I mean, if that's all you got, it's a little easier. But if you've done things like, as we said, rollovers or qualified
QCDs,
charitable distributions, or maybe some 72Ts, anything along those lines, talk to the Lucia Capital Group financial advisors, because they can at least alert you to this fact. They can say, look, everything's in order, but please, whoever's doing your taxes, write this down. Tell them that you did this, because they will say, okay, then that is not taxable income in certain circumstances, and you don't have to pay it, even though the IRS was sent, some kind of 1099. So just 1099 is just information.
Yes.
That from the IRA, let's say custodian, or
from your pension, from the annuity company,
wherever, depending on what type of 1099. It's just information, and then it's up to you to, if you don't owe taxes, defend it and say, here's why I don't owe taxes.
Right. I mean, there's a 1099 miscellaneous, a 1099 NEC. There's a bunch a bunch of 1099s.
Yeah, and they thought they were being helpful by putting, like DIV.
Well, it's the divividends.
It is, but
INT is interest, and 1090B is sales. Wait a minute.
That's where it breaks down, doesn't it? Should be 1090S, 1099SAL,
or 1099CG, capital gain.
Yeah. No, but don't start something and then give up on it. Out of time, if you want to talk to any of the Lucia Capital Group advisors, especially about things like taxes, because this is on people's minds, 800-644-1150, the number at Lucia Capital Group. You can also go online at Lucia Cap, LUCIACAP.com. We got articles and videos and things on this very topic if you want to take a little bit deeper look into it, LUCIACAP.com. Find us on Spotify and Apple and all kinds of things. If you want to subscribe to this podcast, if you just found us for the first time, you have missed a wealth of information over the last few years. Subscribe and find us and get this downloaded to your device every single week. My thanks to Professor Rick Plum, CFP professional. For him, I'm your podcast host, Johnny Dean. Thanks so much for listening. We will talk to you again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. To the extent that this material contains tax matters, it is not intended or written to be used and cannot be used by a taxpayer for the purpose of avoiding penalties that may be imposed by law. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. No client or prospective client should assume that the information presented serves as the receipt of or a substitute for personalized advice from Lucia Capital Group or from any other investment professional. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Insurance services offered through LPL Financial or its licensed affiliates. California Insurance License Number 0518721. Treasury securities are backed by the full faith and credit of the U.S. government, but are subject to inflation risk. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with, and security and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. The investment professionals are affiliated with LPL Financial and are conducting business using the name Lucia Capital Group, a separate entity from LPL Financial.